You don't want to ever take silver anywhere back near the 35 level again. Let me put it that way. But basically, don't ever go back to the highs again. Don't even approach them. Don't even go back to 34 again. Okay, if you do, you're not going to stop this time. And we suggest strongly that if you get back up there again, and then you get gold back up within $50 of its high, you hit 2,800, you get back up in the mid 2,700s again. And I think we traded over 2,700 this week at some point. You get back up in the mid 2,700s, not even back to the 2,800 high. Don't count on the next advance being similar to the ones we've seen this year, meaning 2 steps forward for gold, 1 step back, 3 up for silver, 2 steps back. Expect something far more dramatic. And we bet that when that occurs, when silver and gold percolate back up toward those levels, the prior highs, that you're going to see the S&P oozing down toward what I mentioned a while ago, toward those levels aren't far below. And that is, I think, the key factor in igniting the metals into a more vertical phase.
In today's episode, we dive into Michael Oliver's bold prediction that a dramatic market shift could occur in the next quarter. As cracks form in the stock market, which has enjoyed years of gains fueled by monetary expansion, Oliver sees a potential breakdown in momentum. This could spark a flight to safety, with gold and silver poised to be the primary beneficiaries. Gold is trading near historical highs, while silver is gaining momentum, with key thresholds of $2,700 for gold and $35 for silver in sight. Oliver notes that breaking these levels could lead to a vertical surge in prices, aligning with historical patterns during market downturns. As inflationary pressures mount and the dollar weakens, investors are increasingly turning to precious metals as reliable hedges. The Federal Reserve's prolonged monetary expansion has driven equities to extremes, but the landscape is shifting. A declining dollar and rising interest in T-bonds suggest a reallocation of capital, further strengthening the case for gold and silver. Oliver emphasizes that the next quarter could be a turning point, with precious metals taking center stage in a reconfigured market. Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and check the pinned comment, because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. For just a few dollars a month, you can safeguard your online activity and protect your financial research from prying eyes.
It's impossible, frankly. Our long-term momentum of quarterly momentum of Bitcoin is in a position where if you keep going up, it's not going to confirm. You'd have to literally leave the earth to confirm it. And I don't think it will. Too many other the more intermediate metrics that we look at, intermediate trends, say, no, you're overbought, you're going to wobble, and you can't afford to wobble. This is a headline event. I like to link it to the tulip bulb mania. Okay, it is highly correlated to the other bubble out there, which is primarily it's U.S. stock market, but mainly the NASDAQ 100, which has been the leader index all the way up, and more than doubled what the S&P did since 2009, and it will lead the downside. And they're both, of course, beating their chest right now, especially post-election. And so I guess you buy the news, right? Okay, we shall see. I'm highly suspicious that by the end of this month, we will have a wobble, especially in the stock market. I think Bitcoin will likely reflect that. I don't mean a collapse, a wobble, a subtle wobble. Let's call it 4% or so off where you are right now. There's a problem with that. I'm talking NASDAQ and S&P right now. If you have that kind of wobble, that doesn't do any damage to the price charts. But our quarterly momentum is very eerie. In other words, when we look at the momentum of the S&P and the NASDAQ 100, yeah, you see the price doing this upward curvature thing. But when you look at momentum, you see a floor that's been used and used and used. In fact, there's 2 floors on each. There's the upper floor and the second floor, but they're very close together. So it's like two sticks of dynamite. You drop back and close this month with a wobble. I don't mean, doesn't have to close down on the month. Just close back for example, I'll give you my best guesstimate. 5,800 on the S&P. It's only a couple hundred points below you right now. That's still up on the month, for example. NASDAQ 100, it's 20,700 is kind of my projected monthly close. That is, if we wobble just a teeny bit next week, I think you're going to probably see further oozing back by those indices. The problem then is, as soon as you open the next quarter, you're in a very dangerous position on quarterly momentum. The kind of structure that if everybody was listening could see the charts that we issue and see the momentum structures, they would say, ooh, that's eerie. You don't want to go there. So anyway, I think we're setting up for that. Now, that also will have major wave effects on the monetary metals. Well, if you just look at if you bought the news, S&P, NASDAQ, like November the 6th, the day after the election, you had a massive upsurge. And November 5th and 6th, excuse me. The 2 days right after, you had this massive gap up type surge. And the metals, monetary metals, did quite the opposite. They collapsed. Silver and gold are trading now back above the price level they were when people sold the news. So if you sold the news of the election, Trump's going to defeat inflation, all this, you're losing right now. Silver and gold are actually back above those levels. S&P and NASDAQ are above the levels where if you bought the news, you're still making some money. Not a lot, but you're making some money. But it's interesting, the monetary metals have regained that loss and are trading higher than they were post the election. I think what's restraining, we still anticipate the monetary metals will have a vertical phase. And you remember the monetary metals took off back in March. We beat the table. We said they're going to accelerate up out of this 3-year wide range. And at that point, silver was trading between $25 and $26. And gold was just above 2,000 yet again. It had been above it a couple times before. But this time it's different, we said. We're going to take off. And they did take off. I mean, gold's no longer 2,000. It's 2,650 area, trading right now as we speak on the front month contract. And silver's trading 31.60. Back then it was 25.26. And it's actually up more on the year, marginally right now, because the S&P's gained some of the last, since the election, and NASDAQ has. And gold and silver have cooled off. But they're still actually up year to date more than the S&P and the NASDAQ, which nobody realizes. They think it's, they got to be beaten, but they're not. They're actually up more than the S&P and the NASDAQ. And we suspect the key ingredient now to engage the silver and gold into a stronger upside is to break the stock market. I don't mean you have to crash it. Start to get the blood flow out of the stock market. Where the assets start to get nervous, they move elsewhere. And there's no time in history where when the stock market collapses, everything else goes down too. There's always some other place they go. And history has told us, 2000 to 2002, 2007 through 2011, gold went up with a break in 2008, but basically rose while the stock market went down. Same as the dot-com tops. Gold went up during that time. So did T-bonds. It was contra. It was a place to go. And if you'll notice in the recent 2 weeks, the T-bonds, which have lagged gold in terms of being an upside alternative, they've been under pressure. They turned up sharply. So somebody's buying T-bonds now. And it's not related at all to the Fed, because if you look when the Fed cut rates in September, T-bond prices went down, yields went up. So it didn't matter what the Fed did, the short end. But suddenly for the last 2 weeks, some asset managers have been buying T-bonds. Why? Are they nervous? Are they starting to vacate their stock positions? If we see any wobble in the stock market, I think you're going to see the monetary metals.
In today's news recap, silver price finally breaks free. In the early hours of the silver market on Monday, we have seen a lot of momentum, and as a result, it is worth noting that the silver market has cleared a major short-term barrier to perhaps run higher over the next few weeks. The silver market rallied significantly during the early hours on Monday, as we are now well above the $31.50 level, an area that I had been watching. We're also fairly well past the 50-day EMAs, and now it looks like we are starting to finally see some momentum coming into the market. Underneath the current trading area, we have the $30 level offering a massive floor in the market, and we had recently formed a bit of a double bottom. This is a good sign, and it's very likely that silver will find that as your hard floor going forward. There's also an uptrend line that supports silver, so the technical analysis all lines up for higher pricing. The question now will be about inflation in the United States. Will it work against silver? We'll see. But also, the silver market is also an industrial demand story as well. And if the economy really starts to take off in the US, silver demand could pick up there as well. So it's a bit of a cacophony of noise, if you will. Nonetheless, the simplest way to look at this chart is that we've been in an uptrend for quite some time. And now it looks like we're going to at least attempt to continue that uptrend. This uptrend is likely to be a bit surprising for some, but when you factor in the idea of the overall trend, as well as the idea that liquidity could drop in a week or so, things could get interesting. Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and check the pinned comment, because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. For just a few dollars a month, you can safeguard your online activity and protect your financial research from prying eyes.
Another one of those pauses where, remember, between 2020 and 2020, early 24, you had this up, down in gold in a range. And you had silver in the staircase to the downside, overlapping. It would go down and go halfway back up, et cetera, et cetera. That tone has totally changed. Now it's all upside, but with pullbacks. So for silver, it's like 3 steps up, 2 steps back. For gold, it's like 1 step up or 2 steps up, 1 step back. Silver is always more erratic, okay? It gets punished more in the pullbacks than gold does, and then on the upside, it gains more. But even that type of behavior, which is different from the prior 3 years, it's a positive direction at least, even despite the pullbacks. I think it's going to accelerate to where you go up 5 steps and then pull back 1, not 2 steps, okay? And I think that tonal change will occur once asset flows start to leave the stock market bubble. And therefore, our focus right now is primarily on the S&P and the NASDAQ 100. It's a bubble. I think it's the bubble, it's the headline chasing bubble. And I know there's a lot of positive assumptions about what Trump might do or can do, but or might like to do, we'll put it that way. And the people, some of the people around him. Not all. Okay, when you scrutinize down the list of some of his appointees, you don't quite get this total free market thing or total change view. And now with Elon Musk and Vivek Ramaswamy, that's different. They're headed in the right direction. The problem is they can't simply dismantle this stuff. They can't just pull a plug and say, okay, it's over. They have to go to Congress to get approval on a lot of these things. It's going to be delayed. It's going to be fought. It's not going to be so easy as they think. And there's the other problem, and the problem would have existed no matter who got elected. We have a stock market bubble. It is the biggest stock market bubble in U.S. history. It's been going on since the 2009 low. And if you look at a money supply chart, you'll see why. Greater monetary growth in the last 10, 15 years than any other prior 10 or 15 years. And Fed funds rates during 10 of those 15 years have been at 0. So, they've been giving money away. So no wonder the market got fueled into a bubble. That bubble will break because it's created errors, embedded economic errors, micro errors by individuals, families, companies, macro errors by governments, etc. And when these errors get ripped open and exposed, they don't go away. And usually that occurs once the stock market breaks its technicals. And we're saying right now, the technicals for massive breakage in the stock market are literally single-digit percents below, especially when we get into next quarter. And all you got to do is the rest of this quarter, the remaining 3 weeks, is to see a minor wobble, and we're with the nooses around the neck. And it's at that point, then suddenly all the data metrics that the Fed likes to hang their hat on, they'll panic. And therefore go what? Monetary expansion, all the panic methods they use. And that will benefit primarily what? the monetary metals.
Do you agree with Michael Oliver's prediction about a dramatic shift in the markets next quarter? Are gold and silver ready to take center stage as safe havens, or do you think equities still have more room to run? Let us know your thoughts in the comments below. And when it comes to exposure, would you prefer holding physical gold and silver, or do mining stocks seem like a smarter play in today's market? Join the conversation. We'd love to hear your take. Now, watch this video right here because it's a perfect fit for you. I'll see you on the other side.